guys, welcome to our YouTube channel. This is Learn Forex Versity. So today we are going to talk about trading patterns, or we can say chart patterns. This is an important skill that if you're a trader, you ought to know it, because it can help you in analyzing the market and understand what's going on in the market. If you want to know more knowledge, or if you want to expand your knowledge in trading, you can stick to the end. Kindly don't forget to subscribe, comment, like. Now, to find us on our social media, our handle is at LFV Forex. Learn Forex Versity is the name of our channel, and social media handle is at LFV Forex. Now let's begin. For you to begin trading, or before you start trading, you have to know the following chart patterns. I'm going to categorize them in 4. As well, there are 4 chart patterns. There ought to be 5, but I'm going to talk about 4 common ones today. And these 4 categories of chart patterns are: the first one is the bullish correction continuation pattern. The second one is the bearish continuation pattern. And the third one is the bullish reversal pattern. And finally, the fourth one is bearish reversal pattern. Now, if you stick to the end, or if you watch the whole video, there is a bonus for the 5th category of chart pattern, which I'll talk about. Once again, our handle is down below. You can find us on YouTube, Instagram, and TikTok. Just search at LFV Forex. Now, for me to begin, I'm going to start the bullish continuation, followed by the bearish continuation pattern. Then I'll go to the bullish reversal and finish with the bearish reversal. Now, bearish are for the sells, the sell trades. Bullish categories are for the buy trades. Now let me put them in a column so that you can be organized. Let me arrange them in a column for just a moment. Now, as we continue, the bullish continuation pattern, this is a pattern that shows that the market is to continue its trend towards the buy, or towards up direction, which means it is a buy trade. The only trade that can be taken there is a buy trade. Bearish continuation means that the market is to continue a bearish trade, and the only trade that will be taken there is a sell trade. Now, for bullish continuation, we have the first one as the ascending triangle. Ascending triangle is drawn like this. Now, for you to identify ascending triangle, kindly look at the top trend line and the lower trend line. You find that for the ascending triangle, the top trend line is a resistance. Now, for the resistance is where you put your stop order slightly above the resistance, so that can be triggered for a buy. Then you put your take profit next to another resistance on the top. The stop loss is slightly below the trend line. The second bullish continuation pattern is the bullish wedge. The bullish wedge is drawn like this. It is also a continuation pattern, which shows that the market is just in a correction. Then it will go on with the trend. And the only trades to be taken in a bullish wedge is a buy trade. Now, the stop loss will be slightly below the lower trend line. The entry will be just above the upper trend line, so that when the market breaks, it triggers your entry, the buy entry, and the take profit will be above, next to the nearest resistance that's above. The third one is the bullish flag. Now, this pattern called the bullish flag is almost everywhere. It's a very common pattern. Mostly I recognize it, or I usually see it in gold, GBP USD, and maybe US30. US30 I see it a little bit, and US 500, but mostly it is in the GBP USD, Euro USD, and gold. If you check it on the 15-minute time frame, you'll see it. Now, a bullish flag looks like this. Now, if you see this chart pattern be sure it's a continuation pattern towards the upside. Now the same goes, the stop loss should be below the lower trend line. The entry order should just be slightly above the upper trend line, and the take profit should be up next to the nearest resistance. You should master the bullish flag because it is very common and it always appears in almost any chart, any 15-minute chart. If you are a day trader, you should be familiarized with this trading pattern, the bullish flag. Now, if we come from the bullish flag, I have got another chart pattern named as bullish symmetrical triangle. This pattern, it's not that much common. Some people call it symmetrical triangle, some people call it pennant, but it's also a continuation pattern. The price is compressed towards the middle and then it breaks to the up or to the down. Now, if the chart is bullish, expect that the market will break to the upside. In this trade, you'll have your entry slightly above the upper trend line. Take profit should be up next to the nearest resistance, and the stop loss should obviously be below the lower trend line. Now, if we come from that, we come to the bearish continuation pattern. Bearish continuation pattern are patterns that show that the trend should continue moving to the downside. Now, this is where we find the descending triangle. Now, the descending triangle, you'll find that the upper and the lower trend line differ. The upper trend line is inclined, while the lower trend line is a support. The lower trend line is a support, it is flat. This is how you identify a descending triangle. Now, this you'll have your stop loss slightly above the upper trend line. The entry stop order will be slightly above the support, and the take profit will be below to the nearest resistance. Now, the second chart pattern that I'd like to talk about is the bearish wedge. The bearish wedge is the opposite of bullish wedge, but this chart pattern should show you that the trade or the market is continuing to the downside. The only trades to be taken for this chart pattern is the sell trades. This trade I'll show you the entry position, the stop loss, and the take profit. The stop loss should be slightly above the upper trend line. Entry should be slightly below the lower trend line, and the take profit should be further next to the nearest resistance or the nearest support. Actually, it should be next to the nearest support. The third chart pattern is that common chart pattern that I was talking about, the bearish flag. The bearish flag it looks like a flag actually. It's very common. I told you it is common in the coils, Euro USD, GBP USD. There's a trade I took, you can check on my videos. It has this pattern. So this pattern shows that there is a continuation towards the downside. You put your stop loss slightly above the upper trend line. The entry sell order should be slightly below the lower trend line, and the take profit should be further away next to the nearest support. Now, the third chart pattern is the bearish symmetrical triangle. Bearish symmetrical triangle is drawn the same, only that for this triangle the market is moving to the down. It's moving down. By down I mean the market is selling. The market is selling. So the only trades to be taken in this chart pattern should be sell trades. For this chart pattern, the market suppresses the price and it breaks vigorously towards the downside. Stop loss should be slightly above the trend line. Entry order should be put slightly below the lower trend line, and the take profit next to the nearest support. We are going to what we call the reversal. We were in the continuation and now we are in the reversal pattern. Reversal patterns are patterns that show that the market is here to change its direction. Now, I'll start with the first reversal pattern, which is the double bottom. This is very common in almost every pair or every currency, every commodity. To identify this chart pattern, you'll find that the market bounces off a support twice before it breaks to the other direction. The stop loss should be slightly lower the upper pivot, entry should be slightly above the upper pivot, and take profit should be up next to the nearest resistance. Now, if you come from the double bottom, we have another one called triple bottom. The triple bottom, it has got two pivots. Now, the market bounces off the support thrice before it breaks to the up direction. The only trade to be taken in this chart pattern are buys. Now, the stop loss should be slightly below the two pivots. Entry should be slightly above the two pivots. The take profit should be next to the nearest resistance. Now, if you come from that, before I go on, this chart pattern is also very common. If you see it, be sure that the market is about to change its direction. Now, when you come from that, we have another chart pattern called inverted head and shoulder. A head and shoulder because it has got the head and the shoulders on both sides. You can translate it directly that way. So this chart pattern is also very common. You find that there is the middle pivot is longer than the other two pivots. So if you want to identify this chart pattern, it's drawn like this, the inverted head and shoulder pattern. Now, the other one was the head and shoulder pattern. Now, the inverted head and shoulder pattern is written like this. This pattern shows that the cells have lost their strength and the market is about to change direction towards the upper side. Now, you have to put the stop loss below the right pivot. The entry should be slightly above the two pivots. Take profit should be next to the nearest resistance at the top. The fourth chart pattern that I'll talk about on the bullish reversal is the falling wedge. Now, this is a very important chart pattern, and I can tell you the most tradable currencies or the most tradable commodities where you can find this chart pattern is the US 500, US 30, and the US 100. It is very, very common. This chart pattern, you find that the price will be going down and the sales will lose their strength, and suddenly the price vigorously moves towards the other direction. So it is very common and it is very profitable. Now, to put your stop loss, you have to put your stop loss slightly below the lower trend line. Entry should be slightly above the upper trend line, and the take profit should be next to the nearest resistance. Now we are going to the bearish reversals. Bearish reversals are chart patterns that should indicate or show you that the bulls are losing their power and the sells are yet to take the command, or they are yet to be in charge. So you find that this market or this chart pattern shows you the market is about to reverse from being a bullish trend to a bearish trend. Now the first one is the double top, same as the double bottom, the double pot. The double top has got the market bounces off the resistance twice before it moves for a sell. So put your stop loss slightly above the upper pivot, entry slightly below the lower pivot. Sorry, stop loss slightly above the lower pivot, entry slightly below the lower pivot, and take profit next to the nearest support. We have the triple bottom. The market bounces off the resistance thrice. Stop loss should be slightly above the lower two pivots. Entry should be slightly below the lower two pivot, and the take profit should be next to the nearest support. Now we've got the head and shoulder pattern. The head and shoulder pattern is the same as the inverted head and shoulder pattern. It shows that the trade is about to move towards the sell. The stop loss should be the same, should be just the same as you've seen in the video. Now we have the rising wedge. The rising wedge, which we trade in the US 30, US 100, and all that. This also shows that the bulls are losing their value and the market is about to reverse. Stop loss should be slightly above the upper trend line. Entry slightly below the lower trend line, and take profit should be next to the nearest support. And last but not least, the bonus that I promised. This chart pattern is called the neutral chart pattern. You can kindly subscribe, comment, and share.